Hi, everyone. I'm Diane Brady. I'm here with my colleague, John Dobus, who, of course, edits the Forbes Dividend Investor newsletter, as well as, John, the Billionaire Investor, FBI. So go check it out. Well, let's just start with the general environment right now. Inflation, we've got the debt ceiling, still insecurity. What are you seeing?
Last time we spoke, just before the new year, we were looking ahead to what seemed to be a tricky time for investors, but really it's been kind of a party for the first 3 weeks of the new year. A lot of worst to first phenomena happening in the market. The tech sector was about the worst place you could be. Tech and consumer discretionary stocks were the worst place, 28 to 33% down last year. Who do you think the leaders are? Tech. Tech's rebounded. Every day you're getting headlines of 6%, 10% job cuts at Alphabet, at Meta, at Spotify. My reaction when I'm hearing a lot of this is, how did those companies ever have that many people in the first place? But Wall Street seems to have really cottoned on to the idea that they're getting leaner, meaner, and more competitive for the future. And it's not unheard of for look at energy 3 years ago, 2 years ago, worst to first. And it's happening again, but this time with technology. Well, dividend paying stocks, which were so nice.
Prudence, right? That's investors do like to see some fiscal prudence, and job cuts can mean you're
I'd like to see it, but I don't think we've seen it for about 26 years. And we've lived on, we've soldiered on somehow through 3 or 4 bear markets and 3 or 4 bull markets since 1997 or 1996. No, this debt ceiling, it's kind of like Jaws. You saw the first movie, that not everybody dies. Sheriff Brody will live on. Then Jaws 2 comes along and blah, 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 blah. So back in 2011, the Congress waited until the very last minute to pass an extension to raise the debt ceiling. It was already too late for the credit rating agencies, the guys who certified all that junk paper as investment grade back in 07, 08.
And they
consider your source. They downgraded the U.S. debt, and that precipitated a 19% correction in the S&P 500 index. But the market was not spanked going into that. I think you could agree we all got a spanking in the overall market, down about 19% for the S&P last year. So yes, it could come to a head. It could get nasty, but I think that, the boy who cried wolf cried it too many times. We've seen the movie before. We know how it ends. And if there is a pullback, you go in there with your shopping bucket and you put everything in it.
Well, I want to talk about that shopping bucket because your latest newsletter, you have a 6-pack of, let's go through the 6-pack of new buys for Forbes Dividend.
Each week I'm looking for, and I don't turn the portfolio over radically, but there are times when things look good, and a lot of things look good. Last week, there were 6 stocks that are classic dividend payers that probably belong in anybody's long-term portfolio. One of them was Lockheed Martin, LMT. They, of course, make military aircraft and other weapons. Yes, the government shutdown would certainly affect a defense contractor, but I don't see a world that will have an absence of violence or the need or no need for military aircraft.
Was it sent down because of fears over a shutdown?
Yes, that certainly did. I remember in October when everything was looking cheap, and it also looked like we were going to go a lot lower, and the fear gripped the market. It was down around $390, and it zoomed all the way up to almost $500, and it's back around $440 and change right now. I don't know if you're a fan of the Italian mathematician and rabbit raiser Fibonacci, but
I will
be. Fibonacci numbers and the Fibonacci retracements are big in technical analysis. So that 110, 120 point move roughly has been halved for Lockheed Martin. So it's not a huge yield that will bowl you over. It's about a 2.8% dividend yield. But like I say, it's one of those great American dividend stocks that you always want to have. A couple of real estate investment trusts came in there. Real estate investment trusts are special kinds of stocks that they invest in real estate. As the name says, REIT, REITs, and they have to pay out at least 90% of their net income to shareholders. They don't pay tax on that amount, but you as the shareholder pay taxes. But at least the taxes are not double taxation. So it's not taxed at the corporate
Capital
level, it's
gain.
taxed at your level. They're priced for their high yields and predictable dividends. So two of the ones that we picked out were Digital Realty Trust, that's DLR, and they are the largest owners of data centers in the United States. Data centers are kind of like the steel mills of the 19 teens and 1920s. You know, you can't do anything really without having massive amounts of data. And Digital Realty is the
Suddenly
major.
trying to remember when Bethlehem Steel went under. So it was still good to be in the steel mills back in the 20s. Correct.